Okay, well, we'll get started. Welcome, everyone. Thanks very much for joining us today. We're going to go through the international dealing schedule and what some of the nuances or some of the tricks and tips that have been that we've been discovering as we go along. So I'll just go through and introduce a bit. For those of you that are not familiar with transfer pricing solutions, we specialize in providing, and I guess we really focus on providing practical, proactive, and really cost-effective transfer pricing advice to companies directly, but also we support a lot of accounting firms throughout Australia and Asia as well. In helping provide transfer pricing solutions to their clients. Transfer pricing solutions, we founded that here in Australia. That was founded by myself, actually starting at home, like most people with their business start from home. And over the years, we've actually expanded across to Singapore. We've got Adriana heading up in Singapore. Adriana worked with me for over 6 years here in Australia before branching out there to Singapore. And over the last few years, we've actually expanded into Malaysia, and we have quite a sizable team in Malaysia as well. So transfer pricing solutions, we can help with all of your services in a sense around Asia and globally, and we have offices in 3 locations. We have been recognised on a local level here in Australia, in Singapore and in Malaysia for our technical expertise. I'm very proud of the fact that our Singapore and Australian offices were considered to be Tier 2 transfer pricing advisors, and you can see there for the nice company that we're up against there in our classification of a Tier 2 transfer pricing advisor. We'll aim for Tier 1, next year or when they bring it out. I don't know how they come up with them, and you don't do any submissions. It's just gets presented out there. So just some of our background. For those that haven't met me yet, my name's Shannon Smith, so I'm the founding director of Transfer Pricing Solutions. My background has been working in Australia, but also in Europe and then I spent quite a significant amount of time in the New York office of a Big Four as well before coming back to Australia and founding Transfer Pricing Solutions. Now, actually, next year is our 15th birthday, so no doubt we're going to have a great celebration for 15 years in running Transfer Pricing Solutions. I left the Big Four as I felt there was a real a need for a boutique transfer pricing advisor, not only to help accountants with their clients, but also companies and more small to medium-sized companies also going global and really needing that expertise. Joining me today as well is Kevin. Kevin's a senior manager and has actually worked with transfer pricing solutions for quite a significant amount of time. He went for a little while to KPMG for a few years and then came back again, which was great. Great to see as well. And also Hong Chuan, who is a senior manager also here with, and you've been with us now for quite a number of years as well. And Hong is also our director of our Malaysian office as well. So I'll get started on what we're wanting to talk about today. And now we will be sharing with you the recording. You will get all the slides as well. So I want to talk about, well, what is the international dealing schedule? Who needs to complete the international dealing schedule? What does the ATO achieve from you actually completing this schedule? So what if you actually understand the why are we doing it and what they're hoping to achieve, that'll help you in the understanding in being able to complete it. But most importantly, what you're really going to get out of today is what are our top basically tips and tricks for each of the different sections of the international dealing schedule. Now, we're not going to just flick through and answer every single question for you when you've got IDS instructions, albeit we do agree those instructions are not very clear at all. So what we want to go through today is really go through each of those different parts of the questions and address some of what we see are the common errors that we see when we're actually getting international dealing schedules coming across, and just some of the tricks that we've actually learned along the way as well. So if we look at, well, what is the international dealing schedule? So the IDS, as we all like to call it as the acronym, but the international dealing schedule, a bit of history. It did used to be called the Schedule 25A. That changed then to the international dealing schedule, which was a lot more extensive, expanded version. Really what the IDS does, and it's part of your company tax return. So it's going to be an extra schedule in your company tax return. There are 2 trigger questions in your company tax return or trust tax return that trigger the international schedule in dealing schedule to be required. But really what it does is it captures the key information of the taxpayer's international related party transactions. And so really what it's actually is a risk assessment for the ATO to really understand the international transactions that your company has with foreign subsidiaries or your parent company, to understand some of that risk. And we always see every year when the ATO comes out with what are their targets and their focus of the year that they're going to be auditing and reviewing. Multinational taxation and multinational cross-border taxation is always a focus point. We've seen that a lot, not only in Australia, but also globally with all the changes we're seeing coming through with the OECD as well. Now, the International Dealing Schedule does provide a snapshot of the company's transfer pricing position to the ATO. Now, there's not many countries around the world that do have such a similar form in their tax returns. There's only a few. Ironically, China actually introduced one and literally copied our Schedule 25A. But you have a number of countries around the world that do have that. We do have it also, obviously, in the US as well. But it's really giving a snapshot of your transfer pricing position without them going to that next level. But the one thing I do really want to highlight is it's really important knowing that this is the snapshot. This is used as a risk assessment tool, and we'll talk about this more as we go through the presentation today. But it's really important to get it correct, and because if it is filed incorrectly, and we've seen this happen a number of times, it really can trigger a transfer pricing risk review or potential audits. And so it's really critical on that to get that right. So I'm going to pass you on now to Kevin to go through, well, who actually needs to complete this International Dealing Schedule.
All right, thanks, Shannon. Hi, everyone. Thanks for joining. So when we look at who needs to complete the IDS or International Dealing Schedule, it's actually applies to all companies, trusts or partnerships in Australia that meet certain criteria. You can go to the next slide, please, Shannon. So one of the key criteria is whether you have an international related party dealings greater than $2 million Australian in aggregate. Now, bear in mind, this $2 million aggregate, it includes your loan balances. So you might have $1 million in overseas purchases, but you have $2 million in loan coming in, it will breach this 2 million threshold. Okay, another one that's not that common that we see is if you have an interest in a foreign branch, subsidiary or trust, there are some disclosure in the IDS as well. Now, obviously, the IDS is not only on related party dealings nowadays, because with all these new rulings coming through, coming in across the year, you will see now that this IDS includes your disclosure on whether or not team capitalization applies to you. You will see disclosure on whether or not you have dealings with hub arrangements. Hub arrangement means, like, for example, if you have dealings with, let's say, a marketing hub or procurement hub offshore, that is the hub arrangement. Whether or not you have some offshore banking unit adjustments, this applies to more the financial institution. And the most recent one will be whether or not hybrid mismatch rules applies to you. Now, we get this question a lot in relation to hybrid mismatch because it's so new, just a couple of years old. We will not talk too much into that today, but we have a separate session coming up in our upcoming webinar. We will keep you updated. We'll talk about what this mismatch rule is, how does it apply, and whether or not you need to be concerned about that. So stay tuned and we'll update you as we go. Now, if you look at all these criteria that we have here, the main and the first criteria, the most important one, is the $2 million threshold. If you meet that, especially when you are filling your tax return electronically, if you answer the question as yes, the IDS will pop up as an attachment to your tax return. But there are some concession provided by the ATO, and this is quite new, it's only about 2 years old, particularly for small business entity. If you are a small business entity under for Australian tax purposes, you might have a reduced disclosure requirement for your international related party dealings, especially in the section 1 of the IDS. Now, we will talk a little bit more into that and into this when we go to the tips and tricks later on in this presentation. Okay, so now that is how you determine whether or not you need to prepare the IDS. But let's look at why the ATO come up with the IDS. Like Shannon mentioned, we previously have a similar form, the Schedule 25A. It was a quite long time ago. It's about more than 10 years before my time. Not to say I'm young, but yeah. So this IDS, when the ATO bring in the IDS, it is clear that this is more expanded and more specific disclosure, and it covers a broad area. It's not only on your related party links. Now it covers team capitalization. It covers hybrid. It covers your hub arrangements. So it generally provides a greater visibility to the tax office in terms of your tax arrangement and your transfer pricing arrangements. And not to mention, IDS also have a disclosure whether or not you have transfer pricing documentation for whatever transaction you are disclosing in the IDS. And obviously, this is a key topic in the transfer pricing world because we all know the importance of the transfer pricing documentation, but we will talk about that in more details later on. Now, what do the ATO do with all this information? Now, you just bear in mind that this information will be used primarily, I would say, to risk assess your transfer pricing and tax risk. The ATO will take this information because this comes with the tax return. As you launch the tax return, this is an attachment to your tax return. They will look at the tax return. They will look at the information in the IDS. They will feed this through their risk engine, and then they will sort of rank you in terms of risk against your peers, similar companies in similar industry in Australia. And then they can then focus on whether or not they will select you or they will allocate any resources to you for a review. Another way to look at this is we can sort of reverse engineer what they are doing and sort of self-assess ourselves before we even think about whether or not we need to do any additional work on transfer pricing, right? One of the things that is often overlooked is that not only on disclosure, the ATO can also look at your profitability, right? They use this information, especially in conjunction with the tax return, to identify potential companies that they are deemed to have commercially unrealistic level of profitability. What this means is basically the companies that are underperforming in the industry. They will generally not pick overperforming companies because what's the point of it? So if you look at yourself, if you look at a tax return, you are not, if you think you're not performing that well and you have in combination your IDS, you're showing that you have a high value of related party dealings, then you get a sense of how risky you will be for the year. Obviously, then the third point, understanding the taxpayer's level of documentation, like I mentioned earlier, IDS, you have a disclosure where to tell the ATO whether you have transfer pricing documentation in place for the transaction and the level of coverage you have for the transactions. It can be 0% to 100%. Okay, if you can go to the next slide, please. Yep. Now, what is the process, right? So we have the IDS, and how does that connect to the risk review process of the ATO? So this is generally what will happen. We all know the data from the IDS is assessed alongside with other information to work out, your profitability, your tax paid, and then they would determine whether or not you will be selected for review, whether or not you are a high value target for them. But if you are selected, for example, in an unfortunate event, if you are selected, what can you expect? ATO will usually start with sending you a questionnaire requesting for further information, because just bear in mind, the only information they have to now is just your IDS disclosure and maybe your tax return. So they will generally ask for transfer pricing documentation. They can ask for intercompany agreements. They can ask for any other supporting documents or your comments on how you price, or we call it the pricing policy for your related party dealings in this questionnaire. Or they can simply just do a transfer pricing record review. They come in and review your internal records. From there, they then decide whether or not to take further action. It could be they are happy with your disclosure, they take no further action, or they could place you under a watch list They will not do anything further, but they keep a close eye on you. They may come back in a few years' time to review you again to see whether or not things has changed, or this can lead to a full-blown audit. Now, as we all know, audit is timely and costly. It includes a lot of resources. You need to hire external consultant to assist with your audit. It is very important, like Shannon said, to get this part right. Just to share with you some feedback from the ATO. I'm not sure if for those of you that are not aware, Shannon is our director, but she's also a lecturer in Melbourne Uni, and she teaches transfer pricing every year. I believe was international tax master class. She get a lot of auditors from the ATOs joining her course every year. And Shannon, do you want to share with us some of the comments on the IDS?
Yeah, so what's been interesting, and so each year we do get a number of ATO people that undertake the masters, the transfer pricing subject that I teach as part of the master's program. And in discussions with them, and it's been consistent kind of, I guess you could say each year, but they actually say that 7 out of 10 international dealing schedules that are lodged, when they actually contact for to actually get some further information. So as we talked about before, the ATO gets the lodged international dealing schedule, and then from that it triggers the risk review and triggers on the ATO side. But these actually auditors has been consistent every time I've asked them, you know, from at a high level, what would be that percentage? But they actually say that 7 out of 10 of the international dealing schedules are amended once they contact the company. So they contact the company or the company's accountant to ask further questions and get further information. And what they usually find is the first step that comes back is, oh, sorry, we've actually amended our international dealing schedule. We filled it out incorrectly, we've amended it. And often what they're saying is that probably a lot of them wouldn't have even got contact had they actually lodged it correctly to start off with. So it's just kind of triggering some of these reviews and just trying to make sure that you're getting it completed. But I mean, 7 out of 10 is a huge number to get when a review process starts. So
yeah, exactly. That's 70% fail rate, right? But just bear in mind this. Well, even if there's an error in the IDS, it's not make or break. It's not, you know, it doesn't impact your tax payable or your tax outcome for the year, but it can trigger unnecessary questions, review, audit from the ATO, and when that happens, it just put a lot of pressure on the management to come up with the files that they are requesting, to come up with the answer they are requesting. It costs you money to engage external consultant to manage this audit or review process with you. It's just a lot of unnecessary stress and cost involved if you did not get this right. So, like we always say, this is the first line of information that you're providing to the ATO. Let's get this right, and then we can, instead of arguing on the accuracy of the numbers, we can argue on the application of the TP methods or TP rulings, right? On the more high value stuff. So obviously in an audit, you can dispute whatever audit findings the ATO have, and this will always generally result in a legal actions. Again, more cost, more time. But one thing I think as a risk mitigation approach, we generally suggest that clients have a good transfer pricing documentation, at least to cover the significant related party dealings they have for the year. Now, we all know transfer pricing documentation, one of the benefits is penalty protection. So if you are disclosing that you don't have transfer pricing documentation on some of your material transactions, the ATO knows you do not have an insurance, do not have a penalty protection for the year. So why give them that excuse? To just consider putting the insurance in place, preparing your transfer pricing documentation, and have a peace of mind that you're covered. If anything happens, at least you will not be penalized for it. Okay, so this is sort of a recap of who needs to prepare and the risk involved. I'll pass on to my colleague, Hong Chuan. He will go through the tips and tricks of the international dealing schedule that we see through our review, to our communication with the ATO over the years. Yeah, Peishi, do you want to take over?
Right, thanks, Kevin. Well, now we've gone through the process. It's more on actually completing the IDS, right? Now we all know you may have confusion in completing the IDS, and we hope that we could help you to make it clearer. And as Kevin has mentioned earlier, I would also like to stress that before completing the IDS, you should have already the proper TP documentation in place to already have tested the international real party transactions that you have. And the IDS is actually merely a tool or disclosing information to that ATO, which is of course equally important, right? How it all links to the IDS is when you answer your yes in your corporate tax return in question 27, 28, or 29, which relates to more than 2 million threshold, whether you have overseas interest, and whether you have in cap provisions or not, right? Now, let's start with question 1, which relates to country by country reporting, which I guess we have gone through in our previous webinar. For those that has CBC reporting applications, you can opt to actually launch the part A of your local file and actually omit to complete question 2 to 17. Well, bear in mind that it's only question 2 and 17, not the whole IDS, right? The IDS goes from question 1 to question 50 plus, right? So you still need to complete question 18 onwards. So if you choose to launch part A, well, question 2 provides a leeway for smaller taxpayers to ease their burden to prepare question 2 to question 17 of the IDS. So the first threshold would be the normal 2 million total related party dealings threshold. The total here means that you need to include the balance of any intercompany loans that you have, not just the dealings itself, not the interest expense, the balance of the intercompany loans. So bear that in mind. The second threshold is whether you are a small business entity, right? Small business entity here means you have the concession where your entity actually has a turnover of less than 10 million. And you're not a significant global entity, which relates to CBC reporting, and your international related party dealings is less than 5 million and 50% of the current year aggregated turnover, right? So if you satisfy any of these criteria, you can answer yes and go straight to question 18 onwards. All right, next slides on question 3 and 4. It's more of a summary of section A of the IDS, with the key difference being question 3 relates to dealings with non-specified countries, and question 4 relates to specified countries, right? These 3 and 4 actually helps the ATO to pinpoint the dealings that you have with entities in the specified countries, which are generally countries with a much lower tax rate. You can actually look at the specified countries in the Appendix A as well, to look at which countries are actually under specified countries. I'll give you some examples. The common ones are Singapore, Hong Kong, where you have much lower tax rate, and you guys would not have known that these countries are actually in the specified countries appendix. So it's actually advised to complete question 5 to question 18 beforehand, then you complete question 3 and 4 after, right? So, all right, on next would be question 5. Question 5 is actually not in the slides, where it deals with stock purchases and sales, which is actually self-explanatory. And the main thing to note is that to not confuse this with disposable assets, which are capital in nature, right? So question 6 relates to royalty or license. Again, I'll need to emphasize that you need to have proper analysis to be performed already, and you've already known that to distinguish between royalty or license in your TP documentation beforehand in order to actually disclose this information, right? One of the most misconceptions is actually purchase of shrink wrap software, for example, to sell, right? Is it considered as a license, right? And actually, it should be considered a stock, as you're actually buying and selling the end product, which is the software. And also another exception to royalty or license, it is based on tax deduction or income rather than the accounting value. So keep that in mind. Next, we have question 7, which is also not in the slides, which relates to rental or leasing, which is self-explanatory as well. And then question 8 is an actually important section which deals with services arrangements. Similarly, you need to make sure that services are actually provided or received, and you have to make sure that the services are in substance services which benefits the recipients. All right. So once you've done that, there are a few important ones that I need to raise, which are, the first one is actually management and admin services, which should only include your support services, your day-to-day routine services, right? And also should include admin services associated with your employee share-based plans. But the actual plan payment itself needs to be disclosed in question 15, right? In this section, like for example, management and admin, strategic management should not be in here. It should only include support and routine services. Next is insurance services. Well, there are a lot of misconceptions with insurance services, right? Where you should only include activities associated with the managing. The keyword here is managing of insurance contracts, right? Which are generally undertaken through intermediaries. An example of this is placement of the insurance portfolio to a third party, right? The managing part of the insurance contracts should be in here instead of the expenditure or revenue that you incurred through the insurance contract, right? Lastly, we have R&D, where the entity is actually providing R&D services on behalf of a contracting party to develop an IP, where the important part is where this entity does not eventually take title to the IP, right? So you're merely providing a contract R&D services in relation to developing an IP for another party, right? So it's more or less a contract R&D activity. So a common misconception here is with software IT services, which relate more to support and maintenance of a software instead of developing it. So developing it is on a different scale, which is R&D, while software and IT services is more on supporting role for that particular software, right? And okay, question 9 and 10. Okay, question 9 and 10 is actually not very common unless you deal with derivatives such as you have your swaps, interest rate swaps, currency swaps, futures, where the ATO would require you to actually disclose information based on how it's treated for accounting purposes. So bear in mind that exchange traded options or futures should not be here unless it can't be separated from your other options or futures, right? So question 9, that's question 10 is debt factoring and securitization, also not very common. Debt factoring is actually generally the sale of the receivables, right? While securitization is more on sale of portfolio of financial assets. And ATO is of the view that they are generally not related in nature. And if you actually do have such arrangements, make sure you address it separately. So for debt factoring and securitization. Then we go with question 11, also another important one, which deals with financial dealings. You have your intercompany loans, guarantee, insurance and reinsurance, and of course other financial dealings apart from derivatives. Loans are separated into interest-bearing and interest-free loans. Okay, another misconception here is the calculation of the average balance. The average balance is actually calculated by adding your opening balance and the balance at the end of each quarter, right? So again, I'll give you an example. So you have your opening balance, which is at 1st of July, quarter 1, which is 30th of September, quarter 2, 31st of December, and lastly, quarter 3, 31st of March. Then you add on your closing balance as at 30th of June, and then you divide it by 5, right? And I've seen a lot of these being calculated wrongly, where they use your opening balance and closing balance and you divide it by 2, right? That's actually wrong. You may think it may average out, but actually, if you add up those 3 quarters together, it will give you a different balance. Unless, of course, the balance didn't change throughout, and it's fine. Guarantees would be fees associated with the guarantee provided. So that's self-explanatory, right? Then we have another section for insurance and reinsurance. Now, the difference here between question 8 is here, it relates to any expenses incurred or revenue earned in relation to your insurance and reinsurance contracts, not managing it. Right? For example, you have your premium revenue in relation to your contract, you have your claim recoveries through your reinsurance or insurance contracts. So these should be in this section, question 11. And lastly, you also need to document the Forex accessible gain and Forex deductible losses during the income year, right? So it's not just in relation to your loans. The Forex here does also relates to trade-related liabilities and receivables, and or any other related party liabilities or payables as well, right? So bear that in mind. Okay. Next, we have question 12 and 13 are more your all cash all questions where you have other related party transactions that does not fit any of the questions that I mentioned earlier, then it should be in here, right? The difference is question 12 is of revenue in nature and question 13 is capital in nature, where you have your disposal or acquisition of assets or intellectual property, right? One thing that is actually hidden in your question 13 is actually question 13F, right? It also relates to research and your R&D activities. If you have your R&D activities, which I assume you are also putting inside question 8, question 13F here also asks you to actually disclose your cost plus R&D margin that you have earned. So you have your cost base and your cost plus margin. So you have to disclose those as well in question 13F, right? Then on question 14, which is also not in the slides, relates to no payment or non-payment monetary payment. So here, also very uncommon, where you have your barter or swaps in relation, between your related parties, then it should be in here. Okay, next would be share-based remuneration. It's a very tricky one, which also means that you need to be will need to be analyzed properly beforehand, as it may deal with different approaches in different jurisdictions. So this one, you need to actually analyze properly before actually disclosing the figures. And one point to note is that the admin charges in relation to any share-based payments should not be included here, right? And then next would be question 16, which is your CCA, cost contribution arrangement. Though this question is just a yes, no, so you have either yes or no. But this is definitely a risk flag question where the ATO wanted to know whether there's any CCA involved, right? The key thing about CCA is that it share costs, right? Some taxpayers may misunderstood the CCA arrangement where, you know, the difference between CCA and a intercompany service arrangement is that CCA does not have a markup, arm's length markup in place, while your intercompany service arrangement should have markup in place, right? When you have a CCA, which means markup is not in action, then ATO would want to know more about your CCA. So which means when you have a CCA, make sure that you have proper agreements in place, right? There's another CCA guidelines as well for you to look at, right? You need to have proper agreements and documentation should be in place to make sure that your CCA arrangement is actually a CCA arrangement, so to speak. And okay, next slide would be question 17, right? Question 17 deals with restructuring events that may have occurred during the income year, right? For restructuring events, it includes when you reorganize your structure, which results in your disposal or acquisition of entities or changes in ownership, right? When you have such things in place, even changes in ownership, you need to disclose it, right? Expanding, downsizing, even if you're liquidating, relocating your business operations or even business lines itself, that results in changes in your functions, assets, or risks, then you need to disclose all these restructuring events in your in the respective columns and using the appropriate coding for the respective restructuring events. Lastly, we have question 18. If you have branch operations, right? So here is very different from your above mentioned questions, where here you need to record your internal dealings with your branch operations. So if you are a non-resident, then your internal record dealings will be with your Australian branch. And if you are a resident, then your internal dealings will be with your overseas branch operations. Right, I think that concludes the IDS briefly. And to add on to that, the IDS actually does not stop at section A, right? There are other sections as well which deals with other matters such as your financial transactions. Also, that's your TOFA arrangements. Interest in foreign entities, you have to disclose what interest you have in other entities, and you have to disclose also your TINCAP rulings, which rulings that you have used, what tests you have used for your TINCAP. Financial service entities, which is not a lot out there, but if you have financial service entities, then you need to complete those sections as well, and also other financial issues. And lastly, as Kevin has mentioned, hybrid mismatch, which is covered in our upcoming webinar, which actually deal with issues behind the recent hybrid mismatch, which to a certain extent is very new to a lot of people, but based on our experience, a lot of the international transactions may fall under hybrid mismatch rulings, which you may not have known of. So keep that in mind. And if you could follow us in our upcoming webinar, that'd be great for you to actually further understand what hybrid mismatch are. And yeah, and to conclude with the key takeaways, IDS is almost likely to be the first point of contact for the ATO has on your international party dealings, right? First thing they'll look at is your IDS, because they do not have your TP documentation, right? They rely on IDS to see what you have, what types, dealings types you have, what have you done with it, what percentage you have used, what methods you have disclosed. Unless, of course, you also have your CPC reporting obligations, then they have additional on contact with this. This is your local and master file documentation, right? The next thing is the value is actually based on accounting values, mostly, but with the exception, as I mentioned earlier, which is the royalty or license transaction, right? As emphasized earlier, again, I'm going to emphasize again, TP documentation should be prepared before you complete the IDS. This is very important because all the transactions should be properly tested, right? And when you have already tested and you have deemed them adhering to the arm's length principle, the IDS should reflect exactly what has been documented in the TP report, right? We have come across a lot of times where there's a TP audit and there are a lot of inconsistency between your IDS and your TP report, then there are a lot more questions to ask as to why the figures differ or your method differs. Why do you choose this and your TP documentation says otherwise? That will not help your case in any way possible, right? Which leads me to the next 2 points. Arm's length pricing method to be disclosed. It needs to be the method used to test transactions and not the method used to for your pricing policy, right? There's been confusion with the codes used. For example, cost plus method versus fixed markup, right? When are you gonna use these two different methods? Right, of course, it depends on your analysis used. Another common one is transactional net margin method versus transactional net margin on the whole of entity basis, right? They confuse both together. So it's actually very important to actually get these methods correct. And then, of course, your percentage of documentation, similar to what extent you have tested the transaction. Generally, it should be 100%. But if you actually put 50%, that may actually raise some flags to the ATO. We actually recommend you actually test all the value, which is 100% of the value, right? Which is generally the case. So if not, that will definitely raise flags to the ATO. Lastly, on the revenue expenditure disclosure, right? Often when we see IDS completed, we see the transaction is actually completed with both expenses and revenue together. And then when we ask, it's actually because one is actually with the international related party transaction, and the other is actually on the other end, which is to the independent party, right? By right, you should only disclose only the international related party part and not the independent part. But on the other hand, we also see transaction figures that are netted off, right? When we ask why is it like this, actually they netted off the figures. Again, example, I've seen interest, income, and expenses coming in, but actually the client actually netted off, and whatever that comes income, expenses, then actually disclose that on loan, which is not correct as well, because it should be disclosed separately. When you have two different loans, you have interest income coming in, that should be that particular interest income for that particular loan. Interest expense should be that another loan as well, right? So make sure it's not netted off. And if questioned by the AO, then you have some issues there explaining to the ATO themselves. And yeah, this concludes the key takeaways that we have for the IDS session.
So if you do need any assistance, and thanks Scott for going through a lot of those, Kevin and HC, our transfer pricing solutions can help you with actually even review or to prepare your international dealing schedule. So we work with quite a number of companies and also accounting firms where they may even get us to prepare the first kind of when they've taken over a client or a new one, the international dealing schedule. Now, if you don't have many changes with the company, at least it gives you a good framework to start off with, and then going forward, you can just be updating it each year with the numbers as they're changing. Obviously, we can help you with transfer pricing documentation, clearly, because of transfer pricing advisors, but some of the more recent areas that we've really been helping clients with, and I've actually left one off on that slide, which is the MUL, is really around these PCG analysis. The latest one that we've been with the draft one that's come out now on the hybrid mismatch. We've got a draft on the intangibles, but more recently, I guess over the last few years, is having a look at the PCG in regards to centralized operations, so procurement, marketing, sales and distributions, or inbound distribution arrangements. And I guess for those of you that haven't been exposed to what is this PCG, I actually call a PCG is the ATO's way of getting you to do part of their audit review process. So what they actually are putting out there is a framework, and it's their practice guidance that they've got there as well. And this is what they're going to use. So rather than them coming out, gathering all the information from you, they're actually giving you their framework. And they're saying, look, if you can go through and answer, in a sense, these questions, you'll see where you sit. And in some of the PCGs, we even have like the traffic lights, the red, the orange, or the amber, and the green. And you can analyze where you might sit in the views of the ATO. And I guess if you come up with a red or an amber, you might think about doing some extra work. If you're in the green, you feel pretty confident. And I guess if the tax office came out, they may or may not review further once you've given this analysis to them. So we're finding we're doing a lot more in this, and the latest one, I guess, that we've been doing a lot more work on, which I left off, obviously, but is the MUL on the multinational anti-avoidance legislation, and we've been doing quite a bit around that. But it does give you that kind of framework and that in being able to present that. And the financing one is one that we've been doing a lot. We do a lot of that with the financing. So when we're going through that, we're looking at your debt pricing that you've got in the cross-border, and we're trying to come up and see whether we can get you into the green, or where is it that you sit, and then advising if there's anything further you need to do, or at least to give, I guess, the directors of the business some comfort as to where they're actually sitting. Now, I'm just going to open it up to any questions. We have got one who's also put their hand up, but if you could put through a question for us. We have a question: if you have the TP documents prepared, is it always 100% on the documentation question? I'll let you answer that one if you want, HC. If you have TP documentation prepared, is it always 100% on the documentation?
Well, it depends on. Yeah, it depends on how the TP documentation is prepared. Right? It also depends on what transaction you have, right? When we look at TP documentation, we look at significance of your we look at significance of your international transactions, right? You may have some transactions that are not material, and I'm talking about in value. Of course, you have to deem it not material in the first place, and then those may not be 100%, right? So it depends on what method you used and what transaction you have tested it on. So let's say you have prepared a TP documentation and you have 3 separate transactions. One is service, one is corporate loan, and one is actually not material. And on the services part, it depends on whether you have used your transactional net margin method, or are you actually testing it on a whole of entity basis and as a service provider itself, then that would actually be 100%, because the 100% here and the percentage here means the value of what you have tested, right? Are you going to do a sampling? Was it prepared based on a sampling testing, or is it actually covering the whole transaction itself, right? So at the end of the day, it depends on how the TP documentation tests your transaction and what method was used. Is the method was used to actually test the whole proportion of the transaction, then it should be 100%. If not, then it should be, we'll rarely see 50%, right? It's either you test it as a whole or you don't actually test it due to immateriality. Unless you have anything to add, Kevin.
Now, do we have any other questions? The people that have put their hand up, if you maybe could put a question. Yep. Another question that's come through. One question we did have that's in relation to a cash amount received from an international related party that is being treated as quasi-equity for thin cap purposes. Does this still get disclosed as an interest-free loan in the IDS, or should this be disclosed elsewhere? Did you want that one, Kevin?
Yeah, so let's have a look at whether or not this is an interest-free loan. If this is considered sort of like a more towards a debt instrument, whether or not an interest is charged, then if it's not charged, then it will be an interest-free loan. Also, that's not a question.
So it really comes down to, I guess, the clarification of, you know, if it is actually equity. Otherwise, if it is, often when it's talking about the quasi equity, often you know, we'll be looking at the features as to whether we actually consider it to be debt, and if it's debt, then there's no interest, and then we would be actually putting that in the interest-free loan as well. Yeah. Our client has only has purchase transactions with related party overseas. Will international related party transactions apply? If they only have purchase transactions with related parties, then yes, definitely that will apply. So that will be, it's an international related party, basically transactional related party dealing. So if they're only buying from overseas, I'm assuming they must be a distributor, so buying from overseas and selling, say here in Australia, that purchase will be an international related party transaction. Okay, I've got another one that's come up in the chat here. It's probably got your name on it, HC with the CBC. Or so I say got Kevin's name, isn't it?
CFC.
CFC.
Yeah, CFC. Sorry, CFC. Oh, okay. Sorry. Yeah. Any interaction between TP and the CFC rules from an ATO perspective, not from what we've been involved with on our side, I guess from the transfer pricing side, we haven't seen it, but I'm sure that on their side, when they're doing a review, they'll often be looking at the overall picture on it. Does a positive response to dealing with a specific list of countries, i.e. potential tax havens, flag particular or automatic red flags from the ATO? Yes. Yeah. Depending on the transaction. So it's, I guess what you're talking about there is in the specified, if you're looking at the countries such as, you know, and a lot of people don't realize that Singapore has that, but it more comes down to making sure that you've actually got the support from a TP documentation in place to actually say that there's operations there and that you're actually conducting business and that there is support behind it. Yeah.
And based on our experience, they will almost always ask additional questions on your specified transaction with specified countries. So even though it's low in value, they will still ask that question.
Yeah. would a loan provided to overseas related party entities be considered under the transfer pricing regime?
Mhm.
Yeah, so that would be considered. So if you've got a loan that's been provided, basically it's then a matter of whether you're going to be charging interest on it, and is it, is that in a sense that is it debt that's being provided, or is it a loan being provided? Do they have the ability to repay that loan? And so that would be considered. You would actually have to go through that process to consider that whether that is in fact should be charged interest on it as well. Another one, if a related party transaction is less than 2 million, do we need to do the IDS? I'll send that off to, was that your section, Kevin, or?
Yeah, generally, if it's under 2 million, then you would not have to do an IDS.
But again, that
if-
comes back to your loan comment, I guess.
Yeah, you have to make sure that the loan balances doesn't push you over the 2 million.
And also if the question 2
Yep, you go.
to 17 as well. I mean, it only relates to question 2 something, unless of course you take no to all in question 27, 28, 29, then that's fine. You don't need to do the IDS. So the main trigger point is your corporate tax return, question 27, 28, and 29. If you have yes in either one, you have to do IDS. If you have no, then you don't need to do that. Don't need to do IDS.
Yeah. So another one, if the purchase is at arm's length price, do we still need to file the international dealing schedule? Yes, you do, because this is actually, you're just disclosing the transactions that have taken place. What we're hoping is that the transactions are at arm's length so that you can support that you have been operating at arm's length. So if you are buying, I guess when you're talking, this question's not as clear. I'm assuming with arm's length that you're buying from a related party. If you're not buying from a related party, then and there's no other relationships, I guess, going further up the chain, then that's not an international related party transaction or international related party dealing. But if the purchase is at arm's length, that's good, because we want you to be purchasing at arm's length. But you do still need to file the IDS from that perspective. Okay, any further questions then? Just
Well, there's one that is related party meaning 50% over control. I think I raised this question to you before, Kevin, for Australia, the 50% control part.
Oh, yeah.
On the
So
related party definition.
So generally over 50%, yes. And also we look at the, I believe we look at the control as well. If there's significant control on the management and operation of the company, we can be considered an irrelated party as well.
Yeah. Great. So we will have a recording. We'll upload this recording now and also with the slides. But if there's any other topics of interest, if you want to have a look and like and subscribe to our YouTube channel, you'll see a lot of different presentations and webinars that we've done, not only Australia, Singapore, Malaysia. There's a lot of changes going on in Malaysia. So that's a great way to keep up to speed, but also across Asia as well. So you can go through to the YouTube channel and you'll see all of our recordings there. But if we can help you at all, please feel free to reach out and we'll look forward to working with you all. But thanks very much for joining and have a great night, everyone.
Thanks, guys.
Thank you.